The market concern is understandable because big tech has moved from being the demand drivers to now being large capital spenders. It's really a role reversal. As you and I have talked, I've really preferred the supplier trade for that reason. However, what I would emphasize is that there are different stages of the AI cycle. We really are in the build out cycle. We are moving into the monetization cycle. So it's not that big tech is going to miss out on AI. It's that big tech's AI moment simply hasn't happened yet. They're later in the cycle. There are signals that there are already early winners, and this is not out of dozens. This is literally, I can talk to you maybe about three or four, Charles, out of the large software universe. To me, that's a great opportunity for investors
Right.
because there's a material difference between those participating right now and those not.
The queen of Nvidia, Beth Kindig, is making a move that should have every serious investor on high alert. If you feel like you missed the boat on Nvidia's historic run, pay attention. The woman who famously called Nvidia the best stock of the decade back in 2018, at a split-adjusted $3.15, is now signaling that the next trillion-dollar opportunities are hiding in plain sight. We are officially moving out of the build phase and into the Inference Supercycle of 2026, and Kindig has identified three specific winners she believes could be the next Nvidias of this decade. Her track record isn't just talk, it's audited excellence. Since May 2020, Kindig's IO fund has delivered a staggering 326% cumulative return, crushing the S&P 500 by over 190% by identifying shifts in the tech landscape years before they hit the mainstream. Today, she is tracking a monumental $530 billion capital expenditure wave, a massive 75% year-over-year surge in AI infrastructure spending. But Kindig's philosophy is ruthless. She only bets on accelerated earnings, using a rigorous 100-point checklist to find the rare few companies that aren't just spending money on AI, but are actually turning it into massive, high-margin cash flow. Tonight, we are revealing the three high-conviction stocks Beth Kindig is betting on to dominate the 2026 landscape. Let's begin with the stock that has become the definitive pulse of the AI economy, Palantir Technologies, ticker PLTR. While the broader software sector has been rattled by what many are calling a SaaS-pocalypse, Palantir is proving it is in a league of its own. Beth Kindig's conviction here is rooted in a fundamental truth. Palantir isn't an AI wrapper or a simple plug-in. It is the core operating system for the modern enterprise. As we move into the inference phase of this supercycle, the demand for Palantir's artificial intelligence platform, or AIP, is reaching a fever pitch. The company just obliterated expectations, reporting a staggering 56% revenue growth for the full year 2025, and they aren't slowing down. For 2026, management is projecting revenue to accelerate even further to 61%, fueled by a U.S. commercial segment that is expected to skyrocket by 115%. What makes this business model so resilient is the ontology, a digital map of a company's real-world operations that creates massive switching costs. Unlike legacy software that charges per seat, Palantir's value is tied to its ability to orchestrate complex AI agents that actually do the work. The numbers back this up. They've seen 10 consecutive quarters of revenue acceleration and a Rule of 40 score of 127, a level of efficiency that is virtually unheard of in the industry. Even in the face of bearish critiques, Palantir's 82% gross margins and rapidly expanding operating leverage demonstrate a scalable software machine that functions more like Nvidia's CUDA than a traditional consulting firm. From an investor's perspective, the current technical setup is just as compelling as the fundamentals. Option statistics are flashing a massive contrarian buy signal, with daily put buying nearing an all-time high of $70 million. Historically, when sentiment becomes this skewed toward the downside, it marks an intermediate-term bottom. With a target of $181 per share representing significant upside from current levels, the market's recent "shoot now, ask questions later" mentality has created a classic mispricing. Palantir is successfully transitioning from a government-heavy contractor to the indispensable backbone of the American commercial AI revolution. If you are looking for the company that is actually turning AI hype into high-margin reality, Palantir is leading the charge. Shifting from the software layer to the raw physical power that makes it possible, we find CoreWeave, ticker CRWV, a company that represents the picks and shovels of the AI revolution like no other. If you think the only way to play AI infrastructure is through the chip makers, you are missing the backbone of the entire operation. Beth Kindig has identified CoreWeave as the stealth mode powerhouse that is quietly rivaling the big three cloud giants. Unlike traditional cloud providers that were built for general web traffic, CoreWeave is an AI-native hyperscaler, purpose-built from the ground up to handle the massive compute loads required by the world's most advanced AI models. The numbers coming out of this infrastructure disruptor are nothing short of explosive. CoreWeave is heading into its Q4 earnings with a projected 105% year-over-year revenue growth. But the real story is in the backlog. As of early 2026, the company's revenue backlog has soared to a staggering $55.6 billion. To put that in perspective, nearly 70% of their projected revenue for the next 2 years is already under contract. This isn't just a hope and a prayer growth story, it is a visible, contracted pipeline of demand from heavyweights like OpenAI and Meta, who are bypassing traditional clouds to get the raw performance that CoreWeave's specialized data centers provide. The market is beginning to wake up to the sheer scale of this opportunity. Recently, Nvidia didn't just expand its collaboration with CoreWeave, it put its money where its mouth is with a massive $2 billion equity investment. This is a massive validation of the business model. CoreWeave is currently managing over 590 megawatts of active power, with plans to hit 850 megawatts by the exit of 2025, and a total contracted capacity of nearly 3 gigawatts. While the company is still in its capital-intensive build phase, its adjusted EBITDA margins are already a healthy 61%, signaling that once the infrastructure is fully energized, the cash flow will be massive. Trading at a forward price-to-sales ratio significantly lower than peers like Snowflake, CoreWeave is a high-conviction time-to-earnings play. If they continue to convert that $55 billion backlog, analysts see a fair value that could triple from current levels. Finally, we transition from the infrastructure powering the models to the company that is monetizing them at a global scale. Meta Platforms, ticker META. While the headlines are obsessed with Mark Zuckerberg's massive $135 billion capital expenditure budget, the queen of Nvidia sees something the rest of the market is missing. Kindig identifies Meta as the world's second-largest AI revenue machine, second only to Nvidia itself. While other tech giants are struggling to justify their AI spending, Meta has already turned its investment into a $60 billion annual revenue engine. This isn't a future promise. It is a current, high-margin reality driven by an AI-powered advertising core that is delivering massive returns right now. The market's current skepticism has created what Kindig views as a value mispricing of the decade. Investors are panicking over the lack of a cloud business to offset the spending, but they are ignoring the smart, sheer efficiency of Meta's monetization. In the most recent quarter, Meta blew past revenue expectations by $1.4 billion, fueled by an acceleration in ad impressions across every single geographic market. This is the strategic inference phase in action. Meta is using AI to make every ad more relevant, driving up conversion rates and maintaining a dominant, profitable 82% gross margin. Even with Reality Labs burning cash on the quest for the next hardware platform, Meta's core business is so powerful that it generated cash flow, $14 billion in free cash flow in a single quarter, all while increasing capital spending by nearly 50%. Beth Kindig's philosophy has always been to follow the expert, strong money, and the data for 2026 shows that elite institutional investors agree. Meta is currently the fifth most popular holding among the world's top fund managers, with institutions owning nearly 80% of the company. With a forward PE ratio sitting in the low 20s, a bargain significant discount compared to Alphabet's 26 times, Meta offers a rare growth at a reasonable price profile. It is a stable, disciplined compounding engine that is successfully transitioning from a social media app into a full-scale AI platform. By the time the market realizes that Meta's smart glasses and superintelligence unit have secured its independence from Apple's ecosystem, the current entry point will likely be long gone.